Residential real estate market, Minnesota, Southeast Florida. Stas Manchek. Let's talk about the elephant in the room. Lots of news going on about all these companies that are folding. Opendoor, Zillow, all of the companies that were buying single family homes and flipping them, turning them into rentals, whatever the case was, using all artificial intelligence data and not a local specialized agent. Here's where they got in trouble is they were buying properties in the same neighborhoods in different time frames from when their people would respond to their ads, and they were basing their new sales prices when they would relist these properties after doing a horrible job of putting paint and carpet or whatever else they did to these properties cosmetically into them at prices that were 90 days ahead of the market today. So if they were list something for $100,000 today, that means that property today might be worth $92,000, but they're listing it 90 days ahead of time because now they're going to raise the comps in that area, in that neighborhood, because they're going to spend more money on buying the next 4 homes to give you new comps, and then those 4 homes are going to be worth more down the line. And that's how that cycle continued. Same thing with Zillow, Opendoor, Redfin. All these iBuyers did the same thing, using artificial intelligence that completely screwed them and almost made them go bankrupt. Well, they're not bankrupt yet, but there's talk that they soon will be because they're losing hundreds of millions of dollars a quarter getting rid of these properties as fast as they can. While other banks like JP Morgan just put together a fund for $1 billion to buy single-family residential rentals. What does that tell you? That tells you that JP Morgan might be ready for a time when there's going to be more inventory, there's going to be more available homes to purchase, and a lot less buyers. We are in the second week of December right now of 2020. The last 2.5 weeks left of the month, 3 weeks left, whatever the case is. And we are seeing the pain that's starting because the banks are starting to freak out. They have made stricter guidelines on funding, even though the Federal Housing Association keeps raising the price on conventional loans. But the market right now is just unaffordable for most people. Because I've said it a million times, I'll say it again. America not only runs on Dunkin', but America runs on monthly payments. And right now, monthly payments at 6-7% interest rates are not that affordable for a lot of people. So what does that mean to you? Let's talk about, certain metros were down 30-40% this month compared to this month last year in sales compared to 2020, 2019. So we're doing less and less transactions all across the board. Certain markets like Arizona, Vegas, where these iBuyers were dominating regular people, taking away their houses, purchasing them for high dollar amounts, where these markets went up 50, 60, 70, 80% in the last 2 years, are now being crushed by the same companies that are now giving these properties away because nobody's there to buy them anymore. So when something goes up so fast, so quick, it's got to come down at a certain point the same way. Let's talk 2008. 2008, September, the market crashed. It took until mid-2011 until the market bottomed out, almost 5 years, because real estate moves slow. So could this be another case of that scenario now? Maybe. But what does that mean if you're a buyer today? So if you're a buyer today looking for a property, if you plan to live in that property for 10, 12, 14 years, or not even live in it, if you plan to keep it for that long, right now is your opportunity to capitalize on sellers that are forced to sell. People that overpaid for their properties that wanted to turn them into rentals, Airbnbs. That market is changed completely, and those owners are in trouble all over the country because people are not traveling as much within the states. They're going abroad, and the vacancy rates are climbing all over for Airbnbs, short-term rentals, VRBOs, whatever the case is. And some of these people pay premium for these dollars because they were basing it off the last year where everybody was stuck in the country, nobody could travel abroad, everyone drove to vacation rentals, worked from anywhere. So moving forward, if you're buying right now, make sure that you offer, a price that's in the future, where the market maybe 5, 10, 15% below where they're pricing at right now, because lots of homes are sitting overpriced in the market for long periods of time. The median days in market grew 13% year over year to 35 days right now as a United States as a whole. Some markets it's climbing much higher, much faster because of unaffordability. So the market is moving slow. Your chance to capitalize on it right now with less buyers being available, more inventory being available. Right now, the tides are in your corner if you can afford comfortably the monthly payment. For sellers, right now, as you know, last time it took 5 years for the market to go down and bottom out. So the sooner that you sell, yes, you don't have the double-digit gains anymore that you had just 6 months ago, but you're still doing pretty well with multiple single-digit gains that you've made in the last 2-3 years, even the last year and a half. So if you are thinking about selling that property that you're bought for a rental, Airbnb, or even if you need to move or relocate, whatever that case is, right now is going to be the highest price that you're going to get for that property because it's going to move down slowly. And then at a certain point, it's going to level out again and start coming back up. So if you're looking to sell, yes, your gains are a lot less than they used to be, but they're still not horrible compared to what your money could have done in the stock market or wherever else you had put it. So you're still doing pretty well in that aspect of it. So just make sure that you understand where the market's headed, how the market correlates to interest rates, to quantitative easing, to the bond market. Find somebody that's going to be able to help you understand where it's going. And if you're looking for a quick conversation, please feel free to reach out. I'm licensed in Minnesota and Southeast Florida. Been around for a long time. I understand numbers. I understand how these things work based on previous data, even though right now the numbers are very skewed because we don't know what the Fed's going to do. And everything's kind of dependent on the Fed. If the Fed moves interest rates back to zero tomorrow, if we have another black swan event, and the banks start to lend again because now they have quantitative easing back from the federal government, well, it's back to the rocket ship. But as of right now, where the numbers sit and how things are going in the economy and how things are slow moving in the real estate industry, just remember that the elevator starts up and starts moving down slowly, and it could take 3, 4, 5 years for prices to bottom out. So depending on the time that you sell, the more money that you'll get in that. So maybe right now it's tough for buyers to purchase, so you might have to get creative financing, contract for deed, own to rent, if you really need to get rid of these properties and if you don't want the responsibility of or the headaches of maintenance. That's where most landlords fail and get their properties destroyed if they don't have a good team, don't have good contractors, subcontractors to fix things, because anything rental-wise, I can tell you, things go wrong all the time. It's not an easy passive job. So that's why if you can't find a good management company that has good vendors, your house could be destroyed by the end of a 2-year lease. And it's happened multiple times over and over again. So if you don't want that burden, don't want that responsibility to manage that property, creative financing is a way out if you need to get out right now. The other thing is, remember, everything is a cycle. The market's been in a cycle for the last 100 years. If you go back and look at the numbers, So let's just go timelines. Last time, 2008, crash. 2011, bottomed out. 2019 was about the year that pricing came back from 2007 to 2019. They met, and then they just skyrocketed because of the C word from there. Well, what's going to happen now is they're going to slowly start dropping down over time and then level out and happen again. So if you buy something, plan to keep it for a long time, that's amazing. That's how wealth is built in real estate, is by buying assets, holding them for a long time, getting tax write-offs, getting whatever else benefits that come with owning something. So if you have questions, feel free to reach out. Have an amazing day. Thanks so much for watching. Remember, subscribe if I can bring you value. Reach out. I'm available all the time. Have a great day.